Alrighty, where to start? Where to start? Where to start? First off, I know that you all, obviously, of course, have avoided all of the bullish Moonboy hype and hopium, but because this is a recording, and I'm probably actually going to upload this one to YouTube, aren't you all watching, if you're not part of the CyPRX community, so sick and tired of being told every single day that price action is going to continue to go to the upside, and then when it doesn't, not knowing why it's not understanding the macro and not understanding the conditions that actually weigh on market sentiment? It's extremely mind-boggling to me that more people aren't persevering or pushing for their education in this space to understand the assets in which they're involving themselves in financially. It's a very immature approach if you don't understand why on days like this, the market looks like this. If you just think it's because, then good luck to you surviving long term in this space. Most likely not a scenario that is going to unfold positively for you and your portfolio. Okay. Everybody on Twitter and everybody on YouTube over the past, let's just say, month has been touting and screaming to you guys that price action is going to continue to go higher and higher and higher. CyPRX has been one of the only communities publicly telling you guys and warning you all that a pullback to some degree, again, we don't have a crystal ball and nobody can determine to what degree the pullback was going to unfold at, but we have been accurately calling out tops in this market under changing market conditions. I'm going to show that to you guys in today's video breakdown, and then you're also going to stick around with us. And I have some of the CyPRX members on the call today. We're going to cover the updated January 13th fundamental report. We'll talk about the remainder of this week and the outlook and the perspective, what could bring back risk optimism to the table, i.e., drive some sentiment back into risk assets and some inflows. And then we'll also talk about the opposite scenario, what could continue to weaken risk assets, which as of right now, um, some things that we had previously discussed on Zoom calls and in fundamental breakdowns, where I had predicted that the market was going to correct the November move, where we were aggressively pricing in 4 interest rate cuts from the Federal Reserve. That has now been dialed back to only 1 interest rate cut expected in 2025, and with some market analysts even expecting no interest rate cuts. And if the data continues to supersede market expectations, where we see strength in the labor market, or we even see sticky and troublesome inflation, that could even bring back rate hikes to the table, which would significantly weigh on market optimism and definitely create a deeper market retracement. So we'll get into those scenarios towards the end of today's video breakdown, but I just want to show you guys, I'm not here at CyPRX, we're not here to stroke our ego or try to like say we're right and we told you so. I'm here to push for people's education because I remember as an early investor coming into this space, my first year to 2 years in this market, especially trading forex, not understanding why the assets that I'm trading were doing certain things. Why on some days the markets were bullish and then turn around the next day and $100 billion was wiped from the market. And I was sick and tired of not knowing why. And so I started reading reports from these large financial institutions, these banks that publicly put out their reports on their LinkedIn profiles. And they're deep economic reports that talk about the macro, that talk about the factors that they pay attention to that lead to either risk on or risk off optimism. And when you read these reports, you start to see what they're talking about is all public information. Central bank policies, labor market data, PMI figures, inflationary reports, GDP, um, political tensions from certain political figures like President Putin, President Trump, so on and so forth, and their stance on economic policy and what they're trying to do with the economies in certain jurisdictions. There's a whole multitude of factors, but all of it is public information. And when I found that out, I was like, this is crazy. How can I incorporate this into my portfolio, into my investment strategy to gain an edge? And we've continued to do that not only for the CyPRX private community members, but just to stay informed with macro conditions and to understand when it's a good time to be a market participant and when it's a good time not to. For example, say yes or no if you guys are listening to this, just so we can get a general consensus. In December, when the markets were pumping heavily, right, and everybody was euphoric saying that the market was going higher, were we buying at those times, or were we here in the CyPRX community saying be patient and wait because we could possibly see a market pullback? Can anybody tell me?
Be patient.
Be patient, right? We weren't buying during the euphoria. We weren't buying when everybody else was screaming all-time highs. Oh my gosh, the market's going to continue to rally in December. especially after Jerome Powell's comments on December 18th, weighing on market sentiment. We were saying, look, we should be patient right now. We should be stacking dry powder and we should wait for discounted prices. And now, today, those discounted prices are here. And I'm not saying that the market bottom is in and that this is where the market's going to bottom out. We could see a price drop lower. But today, on days where over $100 billion are wiped from the market, this is when opportunity presents itself to enter into the market at a discounted price to keep a low dollar cost average level, especially if you're not utilizing leverage. Okay. And you actually want to see an increase in your portfolio substantially higher than somebody who's just randomly entering into the market. Today is one of those days. Okay. So I just want to show you guys that we were publicly telling you all that this was going to happen and what factors, now fast forward to today, were going to unfold on the market to be paying attention to. And as you can see, I just want to show you guys, look at this report. This is a UBS report, okay, the year ahead 2025. And I shared this with you guys on Twitter. We shared this in our private CYPRX community. And in it, it specifically talks about Fed monetary policy. It talks about the geopolitical tensions. It talks about central bank positioning, and it talks about the risks that could unfold or weigh on market conditions. And then we also shared with you guys an entire private CyberX Zoom call on December 17th, where with the community members that are on this call right now, when the market was at a high, which I'll show you guys in just 1 second, we had said that if tomorrow, because this was December 17th when we had our private CyberX Zoom call, the next day, if Jerome Powell came out hawkish, which he did, fast forward to today, that this was most likely going to weigh significantly on market sentiment. And we called that out to you guys publicly and in our private community, just to show you guys I'm not making this stuff up. There is a feature on TradingView where you can publicly copy people's tweets and when they put information out to you guys, and you can slap it on the TradingView charts and you can actually see, right? You go over here to the little drop down menu, you click the tweet section, and it allows you to post a link from someone's Twitter page. And you can see when they put information out to you guys. Look at all these tweets that we put out to you guys here at CyPRX at a market high. Here you can see I said, the rest of the week will set the tone for the remainder of 2024 heading into 2025. Don't be blinded by greed. Know when the sentiment shifts by knowing what to look for. A pause on interest rate cuts from the Fed. Hawkish Fed comments. A risk in inflation leading to a pushback on rate cuts, right? Then here, the next day, December 18th, I said, we tried to warn you guys, intraday pullback engaged. Hawkish comments from Jerome Powell. That was when I released our previous Zoom call from the 17th that we had in advance with the CyPRX community to you guys publicly. And you can see all that information was put out to you guys at the local top. And then the following evening, I put out another video breakdown specifically going over that Signum and UBS report, reading it, and going over what factors that could continue to weigh on risk sentiment as we headed into 2025. And so you can see here, right? I'm not making this up or trying to say I told you so, but we publicly put this information out so that way anybody that's confused on why the market looks like this, if you had just followed CyPRX or you were involved in our private CyPRX community, you'd know why now. Okay. And you wouldn't be confused or be concerned or be fearful. And what this information allows you to do is not only strategically position yourself on the correct side of the market, right? Even if you're just a dollar cost averager, it's important to learn this stuff so that way you're not buying into the pumps, you're not buying into the rallies, and you're able to stack your dry powder or your cash on the sidelines when everybody else is greedy and euphoric, and you can then wait for days like this to enter in and build a good dollar cost average position at lower prices. Okay. Which is extremely paramount. Like I said, if you're not using leverage, if you actually want to see a real significant price increase in your portfolio in the short term, right? You actually want to see short-term gains, then you should strategically be positioning yourselves at discounted areas of interest. All right. So I just wanted to show you guys that we were publicly talking about this. Let's get into today's report. Let's talk about market sentiment and let's go over some conditions that could unfold later this week that could either turn the market back around, right, which we would all ideally like to see, or my prediction is that the market, if the economic data supports it, is most likely going to continue to weigh on market sentiment if we see those rate cut expectations continue to be dialed back. And I mentioned in previous video breakdowns to you guys listening on Zoom that if, just logically speaking, the market had been pricing in 4 interest rate cuts starting back in September, And now the market is pricing in one to possibly zero interest rate cuts in 2025. If that continues, then the most likely scenario is that we are going to start to target these previous higher lows where their over leveraged buy positions exist in the market, where all of these market makers and people that actually move market sentiment were pricing in for interest rate cuts. Now that those expectations are being dialed back, if that sentiment continues, these are the target areas where they're going to be targeting, right? So just keep that in mind moving forward. I'm not saying that that's the scenario that's going to unfold. We have to remain data dependent. So let's jump in and dive into today's economic report. If you guys want to open this up and read it, I think that this is a really good report, really good detailistic perspective on what to be paying attention to. So I'm just going to read this top down, and then towards the end of this is when we'll get into the market scenarios that could unfold this week, and we'll talk about those in detail. So, market overview, January 13th, 2025. Over the past 24 hours, the crypto market has shed another $100 billion. So I will be updating you guys with some DCA positions in the private chat later today, because any day that the market's over or down over $100 billion are days that I look to enter in. Erasing gains from November's post-election rally. Markets had previously priced in, excuse me, four Fed rate cuts for 2025. This is again starting back in September of last year. And then fast forward to today, that number has dropped to only one, with some market analysts even eyeing zero cuts. Better than expected labor market data last week and sticky inflation over the past consecutive month or previous month are feeding concerns that the Fed may remain hawkish and potentially even hike again if economic conditions run too hot. So how we got here. September through November. So September, October, November 2024, the markets priced in four Fed rate cuts for 2025, which fueled a rally in risk assets. You can see here some of the conditions that led to that rally. We had four rate cuts priced in. We had cooling labor market figures in September, in October, and in November, which obviously, of course, support the rate cut narrative. We had the supportive rate cut commentary from Fed speakers, multiple Fed speakers. And then we also had the sorry, that's a tongue twister. The Trump trade euphoria, right? Where because President Trump won the election and he's extremely pro crypto, and he came out at the end of, I think, 2024 in like November screaming crypto's the new like freaking financial system, and said all this positive stuff about Bitcoin and regulations that are going to unfold in 2025 and pro administration that's he's bringing into crypto. It sparked all of this euphoria. And now the market's starting to come to its senses and dial all of that back, which again, we warned about in previous Zoom calls and in previous posts. All right. So now fast forward to like December timeframe. Risk sentiment started to shift, starting with December 8th. Political turmoil abroad, where we had the fall of the Syrian government, which raised geopolitical uncertainty. As you can see, that was on December 8th. That was where we saw the first outflow, or the market start to signal a possible local top or temporary pullback. Then on December 18th, we had Fed Chair Jerome Powell surprise the markets by hinting at fewer rate cuts and push them back down to two at that time, sparking a risk-off sentiment. Here you can see on the charts, hawkish Fed, December 18th. We also saw another massive outflow. Actually, that day, that week span of price action, we saw over $600 billion wiped from the market. Then December 25th, on the Christmas rally that everybody thought was going to bring back optimism, and the market slightly bounced from the previous week on December 18th. On that day, December 25th, while everybody was celebrating Christmas, we had a Russia-Ukraine tension escalate, adding to another layer of geopolitical risk. And you can see that on the charts here. Again, we had another outflow of risk assets. And then last week, we had multiple Fed speakers reinforcing a hawkish stance for monetary policy from the Federal Reserve. We had strong PMI and labor market figures also support a more hawkish Fed narrative. All right. And you can see again, slapping that on the top of the charts. That is another thing that weighed on risk sentiment. And so now we are here. All right. So key data points from last week, because we had the NFP figures and we had the unemployment rates, which we had projected in a previous Zoom call in the private community, that if the data came out extremely robust, it would most likely lead to subdued strength in risk assets, which is what we're seeing today, right? The U.S. labor market, or sorry, excuse me, the U.S. Labor Department's December report showed job growth accelerated to 256,000. If you guys remember, when I gave you a detailed analysis, the market was projecting 100 and I think it was 64,000 jobs, right? And so we came out almost 100,000 jobs higher than the market had expected, which shows extreme resilience and strength in the US labor market. The unemployment also dropped to 4.1%, the strongest monthly gain since March. All right. And so in that detailed Zoom call that we had, where we broke down, I think it was on the 5th of January, if I'm not mistaken, we broke down the economic data in detail. We talked about the positive scenario for labor market data and the negative scenario that could unfold. And we saw the negative scenario that we had talked about. Okay. Which was extremely upbeat US labor market data weighing on those rate cut expectations. Yields last week also surged after the robust payroll numbers, reinforcing the expectation that the Fed could maintain restrictive monetary policy for most of 2025. When yields tend to rise, obviously, of course, inversely, risk assets tend to depreciate as yields are seen as a safer investment comparative to risk assets like stocks and crypto, which is just another indicator that shows that we are in a risk-off market mood temporarily. Keep in mind, by the way, if you guys are watching this and you're not part of the CYPRX community, we are not bearish by any means in the crypto space. I am extremely bullish and I'm not selling out of any of my long-term positions right now, even in this market turmoil in this pullback. Okay. Long term, a year from now, 2 years from now, 3 years from now, upside momentum is still intact. But short term, are we experiencing a market dip in price action and market sentiment? Absolutely. And it's important to understand these things and why, so that way you can actually survive long term mentally. And let's say, for example, if you're an XRP, could you imagine being an XRP holder that has no idea why the heck your XRP isn't $5 right now, right? Because you've been watching bullish moon boys telling you that it's going to be, and then today, like say for example, you bought when it just recently surged to like, I don't know, what was it over the weekend, $2.60 or 55 cents, right? And then today, if you put $1,000 into the market over the past weekend, now that $1,000 is not worth $1,000 anymore today. Could you imagine the mentality of the average retail investor that's doing shit like that? Oh my goodness gracious, you're destroyed. You're destroyed. You're setting yourself up for failure. Okay. So why risk sentiment is dampening? First, we have inflation and growth concerns. A hot economy under the new administration is reigniting possible inflationary fears, forcing the Fed to stay hawkish. Also, we are obviously, of course, not seeing inflation come down month after month and year after year, as we saw in the most recent inflationary reports. And then this week, also, we have inflation data to be paying attention to. We've also had hawkish Fed commentary, where policymakers last week have continued to signal a higher for longer rate path unless the economy starts to deteriorate, which as of right now, time of recording, is not to be the case. Okay. Then we've also had a reversal of post-election Trump euphoria. Markets are now relying on actual economic data rather than overly optimistic rate cut hopes. This is a screenshot from an economic report from Reuters, I believe, or CoinShares, one of the two, where you can see here it reads, the Federal Open Market Committee's latest meeting in minutes suggested a stronger U.S. economy and a more hawkish Fed. Keep in mind, you guys see here, they're mentioning terminology, hawkish Fed. This is a report from today, January 13th. What were we telling you guys all the way back on December 17th? Look at this. Literally the day before the market turned around. This is the type of stuff you want to see via the influencers that you're following on the internet to see that they're actually putting out good information. I literally said to you guys, the rest of the week will set the tone for the remainder of 2024 heading into 2025. Know when the market sentiment shifts by knowing what to look for. I said a pause on rate cuts from the Fed or hawkish Fed comments. And now fast forward to today, you see retail articles catching up where they say what's weighing on the market? Hawkish Fed commentary, strong economic data, pushback on rate cuts, right? Here, this economic report also says that this suggests that the post-US election honeymoon phase is over and macroeconomic data is once again a key driver for asset prices. However, here at CYPRX, it has always been a key driver. That shit never changes. Like, you don't just put economic data on the side because everybody else is your fear can choose not to pay attention to it. No, every single day, every single week, you pay attention to the economic data because these are the drivers that these large financial institutions are paying attention to make their investment decisions. All right. And so we as manual retail investors, if we want to operate on the same intellectually inclined level that these financial institutions do, even though we can't to some degree because we don't have as much information and as much data and as much tools as them, we can still attempt to compete. Okay. So I said here, this is exactly why in previous reports we mentioned to remain data dependent, keep dry powder on the sidelines, and not get too overly optimistic. This was back in December, where we were probably one of the only private communities warning its members of a possible pullback. And so now we're here. Here you can see another economic report from Reuters, January 13th. Futures, a risk asset class, right? Stocks slide as investors dial back bets on Fed rate cuts this year. So I'm just trying to mark the stamp and show people that CYPRX is way ahead of the average retail investor because we're paying attention to the things that the financial institutions pay attention to. It is not hard or complicated to understand. So let's take a look real quick at the economic calendar coming up this week. Our main focus is obviously, of course, going to be on the US data. We do have some Japanese inflation data, which I did not cover in this report, but we will talk more about in detail maybe in tomorrow's Zoom call because it's not till later this week, the second half of the week. I think it's on Wednesday or Thursday. It's some PPI figures, some inflationary figures that we need to pay attention to for the Japanese economy. But I did talk about it in yesterday's report. So if you guys are watching this Zoom call, then just go back and read yesterday's report. I discuss and talk about that a little bit. Keep in mind that nobody is talking about the possibility of a Bank of Japan rate hike, which could significantly drop the markets because that would most likely lead to the yen, the unwinding of the yen carry trade, which I haven't seen any influencers or people on the internet publicly talk about. I feel like we are one of the only communities that have discussed the possibility of that unfolding, which would, I mean, I don't even know. I honestly don't even know how to predict that because it would be catastrophic in my personal opinion. Okay, based off the research that I've done and looking back at previous yen carry trade unwinding events and listening to Bank of International Settlement podcast saying that the next one that unfolds is most likely going to be much more severe, keep in mind it could definitely drop the markets if it did unfold. But I don't think that that's something that we have to worry about right now, imminently, at least not until like March of this year, maybe rolling into April. We'll see. All right. We'll bring that back up for discussion in another Zoom call. But so for this economic calendar this week on Monday, that's today, we have the New York Fed's inflation expectations. And we have U.S. Treasury's monthly budget balance, which it's not anything too significant to be paying attention to. Tomorrow, our main focus is going to be on inflation data. We have the Small Business Sentiment Survey, and we have Producer Price Index, or the PPI. Then on Wednesday, we also have the Consumer Price Index, or the CPI, which is a key inflationary figure for the, Federal Reserve monetary policy stance. And then plus, we also have the initial January manufacturing data as well. So Tuesday and Wednesday, along with when is the unemployment claims? I think unemployment claims is on Thursday. Those will be our primaries this week. All right. Thursday, we also have retail sales to be paying attention to, which will give us some insights into the strength of the U.S. economy, import-export prices as well. And then Friday, we have housing starts, industrial production. And then heading into the weekend, the market will be closed for a 3-day weekend. All right. I think the holiday is on Monday, if I'm not mistaken. So just be mindful of that. As any bank closures for you FX traders that are watching. Just to do a real quick recap, because I really like this portion of the Fed's meeting in minutes because it really gives us insights as manual retail investors as to what we need to be paying attention to, and we cover this in previous reports. So here you can see a little screenshot. This was on page 11 of the PDF from the Fed meeting in minutes. Many participants noted policies could remain restrictive longer if inflation stayed elevated. However, policy could also ease more quickly if labor markets weaken, economic activity slows, or inflation returns to 2% faster than expected. So this literally gives us a bullish and bearish scenario. It's not 100% guaranteed, but it is the most likely scenario if these factors were to unfold. And so that allowed me to create these two possible scenarios for you guys. So you all listening in that are not part of the CYPRX private community, if you don't know how to pay attention to this stuff and you want to learn more about it, you want to jump into a community that covers this stuff intraday. Every single day we have Zoom calls, every single week we have a zoomed out perspective, looking back at data and looking at forward projection possibilities, then tap in with us. This stuff is extremely easy and it situates us on the right side of the market. So if we want to see this most recent market downturn correct itself significantly, right? We want to see a possible bottoming out here after this most recent market decline. And we want to start to see some demand pick up at these lower prices where we can see clear demand picked up previously, right? Maybe something like this, another drop to liquidate early buyers beneath lows, and then a market recovery from this most recent market downturn, or possibly heading into Asia and London session, maybe even another deeper grab of liquidity, but then a bullish turnaround from previous bullish areas. If we want to see something like this in the market this upcoming week, These are the scenarios that we would most likely need to see unfold in terms of economic data. All right. So data weakens, renewing rate cut hopes, risk appetite resurgence. We would need to see number one, some soft CPI figures, inflationary surprises to the downside, showing a meaningful drop in both headline and core readings. We would also need to see slowing labor market figures. Weekly jobless claims, I believe, like I said, is on Thursday, need to creep higher, showing more people are filing for unemployment claims. Wage growth would also need to cool, and next month's payroll would need to come in below market forecast, but that's not until February, the first week of February. So that's not something that we need to worry about. More so, we're just looking at unemployment claims this week. Consumer spending would need to retreat. Retail sales would need to miss estimates, implying less consumer momentum. We'd also need to see some type of Fed pivot chatter. Right? I don't think there are a multitude of Fed speakers this week, but ideally we would like to see softer data prompting a more dovish language or perspective from key Fed officials, where markets could then once again start to price in multiple rate cuts for later in 2025, which would most likely ignite a rally in risk assets, including crypto. Also, we would need to see some ceasefire talks in the Middle East, Russia and Ukraine, to spark optimism on a global scale. And then lastly, President Trump's tariff uncertainties would need to ease, and market fears of a trade war would need to de-escalate. We do have President Trump's inauguration, I believe, this week, if I'm not mistaken. Or no, is that next week? Yeah, 20th, I think. So that is coming. But ideally, we would need to see some easing uncertainties surrounding President Trump's tariffs, leading to possible increases in inflation start to ease. All right. This would be a rainbow scenario where everyone goes home happy. Implications for the markets, if these scenarios unfold this week, would most likely be a risk-on market mood, where crypto and equities and other growth-sensitive assets rebound on renewed hopes that the Fed might begin easing sooner than expected currently, which right now the market is only pricing in 1 to possibly 0 interest rate cuts for the remainder of 2025. We would like to see those interest rate cut possibilities increase and come back to the table. A yield pullback, we would like to see Treasury yields drop, reflecting the market's recalibration towards looser monetary policy in the near future. And then we would also like to see dollar soften. Any dovish Fed commentary or outlooks weighing on the greenback, supporting emerging markets and commodities. All right. Like I said, this will be a rainbow scenario. I don't think that this is going to happen based off of current market conditions, but it's still something to be optimistic about. And in this scenario, what would most likely unfold is we would hold these most recent lows, i.e., not breaking into new lows or breaking beneath, closing below these December lows on the 20th. We would most likely hold roughly about $3 trillion to $2.9 trillion. And we would most likely start to see some type of market recovery from this most recent downside move. The inverse scenario. Let's talk about the opposite. What would create a deeper market retracement where we would see a failure to break above previous lower highs in comparison to the previous ones. And we would most likely start to continue to see a deeper pullback, correcting more of this previous upside move from November, possibly breaking and closing bearish below $3 trillion, revisiting 2.9 trillion, and possibly breaking those mid-November higher lows. Right? This is where I would start to be concerned of a much deeper retracement, because if we do break these mid-November higher lows, there isn't real any support from a technical standpoint until we reach November lows, which puts us all the way back at $2.1 trillion. So if this scenario were to unfold, where we did break below 3 trillion, possibly revisit 2.9 trillion, or even break below that under extreme market uncertainty and economic conditions weighing on risk assets, worst case scenario is we correct fully this previous November move and we place ourselves back down at 2.4 to $2.1 trillion, right? Right now, that's not something that we have to worry about. We need to see a break and close below $3 trillion to $2.9 trillion first under these market conditions. All right. So scenario number 2 this week is if we see robust inflation where CPI and PPI remains elevated or even exceeds market expectations, particularly the core readings. Any strong labor market figures, so the unemployment claims or any payroll data continues to surprise to the upside or show strength and resiliency, and wage growth remains firm. Consumer and business spending, where retail sales beats estimates. PMI surveys suggest ongoing expansion in economic activity in the United States. Or any hawkish Fed commentaries with any upbeat data, where Fed speakers reassert the need to keep policy tight, or even possibly mention a further hike if inflation fails to cool. All right. I did not add in these scenarios, which I guess I could live here. If we have any geopolitical tensions escalate, or if we have any continued uncertainties with President Trump's tariffs. Okay. So if we see any of these factors unfold this week, it is most likely going to continue to lead to a risk-off market sentiment or a deeper market retracement compared to where we are trading at today as of time of recording. As I mentioned, risk-off market mood, crypto and other speculative assets would most likely face downward pressure and tightening fears as tightening fears persist. Yields would most likely continue to surge, where treasury yields would continue to rise further, pricing in a reduced chance of a Fed rate cut in 2025 and possibly factoring in another rate hike. And then also a stronger dollar, where any hawkish Fed comments and higher yields would most likely lead to a boost in the dollar, possibly breaking above the 110 or the 111 psychological level for dollar strength. Okay. And we have this lady here drawing exactly what would most likely unfold in risk assets, which would be a deeper retracement. Okay. So, in a nutshell, that is what we need to be paying attention to this week. Those are the economic projections. Now we can all hope for these scenarios to unfold. Ceasefire talks, easing concerns surrounding President Trump's tariffs, cooling in the labor market, lower inflation readings, positive regulatory developments, or institutional inflow into digital assets. That would be the ideal rainbow scenario. If we do not get that and we get the inverse, be prepared for a deeper market retracement. Okay. However, you are going to situate yourself in that scenario, be mindful of that and start to prepare for that. I know what I will be doing, which is waiting patiently for better, deeper opportunities to build my long-term positions and blue chip assets. Okay. Keeping in mind the long-term bullish perspective still remains intact. Okay. On a side note, there was one fundamental piece that I did find where they were talking about the possibility of ceasefire talks in the Middle East. Although this would not completely turn around the market sentiment, it would be a positive start if we could see ceasefire talks this week fully come into agreement and the war ceases to exist in the Middle East. Here's that report right here if you guys want to read it. I wasn't able to fully digest it, so I didn't fully incorporate it into today's fundamental report, but I did add the link for you guys because I wanted to get this Zoom call out of the way as the market did drop this morning. I wanted you guys to all understand the market conditions and what to be paying attention to this week. So I will stop the recording here. I'll leave the floor open for questions for you guys on the Zoom call. We'll talk about the markets. We'll talk about this upcoming week. Just have kind of a quick open discussion as we end today's Zoom. For you guys watching this as a recording, many blessings to you guys. If you guys enjoyed this, make sure that you subscribe to the YouTube. And make sure that you smash that thumbs up button. It will help boost that algorithm and push this educational video to more individuals like yourselves that actually care about learning the market conditions. If you want to dive in a little bit deeper, you want to access all the information that we provide for our private community members here at CYPRX, then head over to cyprxtrading.com. We'd love to have you on the team. With that being said, I'll see you guys in the next breakdown. I'm going to end the recording here and leave the floor open for you guys and questions in the private community.